Bitcoin has just soared past $107,000, yet again. What's behind this surge? A ceasefire in the Middle East, a weakening US dollar, and growing institutional interest. Welcome to the Digital Finance Daily News Show, a place to get all the crypto and macro daily news in a single serving. Don't forget to subscribe while you are enjoying today's stories, and a big thank you to all our new subscribers over the last few days. In recent days, spot Bitcoin ETFs have recorded an incredible 11 consecutive days of inflows. That's over $588 million, with BlackRock alone contributing $436 million today. This massive influx has pushed IBIT's holdings to more than 662,500 Bitcoin, almost 3% of the circulating supply. Why is this significant? Every dollar entering these ETFs means real Bitcoin is being removed from circulation. This reduces the available supply, increasing upward pressure on prices as demand surges. Unlike retail traders, institutions are not just flipping tokens, they're holding onto them. Let's take a look at the on-chain data. Whale wallets, holding over 1,000 Bitcoin, have added more than 19,000 Bitcoin just this June. Meanwhile, retail interest is waning. Google Trends indicate that searches for Bitcoin have dropped by 25% since May. This surge is driven not by retail, but by large institutions methodically accumulating supply. Broader economic trends are also playing a role. Stocks are climbing, with the Nasdaq hitting record highs, while the S&P and Dow have all risen over 1%. Oil prices have dropped 7%, hovering around $65 per barrel. The US dollar is at a one-year low, which is lifting the risk for various assets. Now, let's discuss Federal Reserve Chair Jerome Powell. He recently testified before Congress, maintaining a cautious outlook. He highlighted potential tariff-driven inflation, warned there's no urgency to cut rates, and underscored the need for clear signs of disinflation before any action. However, the Fed might be underestimating inflation pressures that could linger. Housing costs often appear in CPI data months later, and wage pressures remain. If inflation rises again, the anticipated rate cuts could be delayed, affecting risk assets, including Bitcoin. Currently, Bitcoin's position is precarious. It's surpassed the $106,000 to $107,000 resistance, displaying bullish technical indicators. Whale purchases and low exchange balances are adding to the momentum. Yet, historically, June has been tough for Bitcoin, averaging a decline of about 5% since 2011. This cycle is different from the ones in 2021 or 2017. In the past, hype was driven by retail investors. Now, it's about ETF investments and institutional players. BlackRock wasn't a player in crypto 3 years ago, but now it holds more Bitcoin than many nations. Interestingly, Bitcoin's correlation with gold has reached new highs. Investors are beginning to view it as a macro hedge rather than just a speculative asset. Additionally, its connection with Nasdaq tech stocks is stronger than ever, establishing Bitcoin as a key indicator for global liquidity and risk appetite. So, what's next for Bitcoin? In a bullish scenario, if ETF inflows continue and Powell hints at potential rate cuts, Bitcoin could break through $112,000, targeting $120 to $130. In a neutral scenario, Bitcoin may stall between $103,000 and $107,000 with declining trading volumes and a stagnant summer. Conversely, in a bearish scenario, if CPI data surprises on the upside and Powell remains hawkish, ETF flows could reverse, causing Bitcoin to test crucial support at $98,000. Looking back, this moment is reminiscent of the 2020 cycle. Following the halving in May 2020, Bitcoin remained subdued for months before launching into a significant year-end rally. A similar gradual ascent may be occurring now, setting the stage for an autumn breakout. In summary, ETF flows are tightening supply, while whales are actively accumulating. Powell's cautious stance keeps retail investors on the sidelines, making Bitcoin's current path pivotal, caught between breakthrough and breakdown. If you want daily insights like this, without the noise, please hit like, subscribe, share, and turn on alerts. Let's navigate these exciting times together.